We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. This is a pre-recording of a Twitter Spaces live event that we hosted last week. If you'd like to be a part of the next one, go on to Twitter/Palisades Radio, and you can be part of the conversation. You can listen to our conversation on the desktop, but it works better on the mobile app because then you can actually log in and ask us questions and interact with us as well. Just as a reminder, as always, you can find our podcast on Spotify, Apple Podcasts, and anywhere you want to listen to it, as well as Odysee if you don't enjoy using YouTube. I hope you enjoy it and hope to see you on the next one.
We were kind of going back and forth on Twitter earlier about, and also I believe there was somebody had tagged us in a chart about how if silver was only traded on the Comex, it would be worth something like 13 cents or whatever.
Yeah, it was actually, it's a cool chart. I don't know how they, if it's calculated just basically on closing prices, opening prices, that type of thing. But it's a good point to bring up because it actually exemplifies what the futures markets actually represent. It's not a price discovery chart as much as it is a hedging or a price discovery market versus a hedging market. And so that's this morning I kind of put up something which I think I tweeted it out this morning that with silver actually, the futures market in silver was actually created back in 1931 by a national metals exchange, which actually was then combined with a couple other exchanges in New York to create ultimately the Comex. But even back in 1931, they talked about how silver, these futures exchanges were created as a hedging vehicle for producers. And that was just like in the grain market and so forth. It was to aid, farmers and ones that were trying to hedge production or hedge crops, that type of thing. So it with the way the futures market works, and this is part of the frustration even I have watching these markets, is that the first transaction typically in a lot of cases is a sell, and that's because the producers are using that market to potentially sell existing production or physical production or physical product or inventory that's maybe not on the Comex or could be at the Comex, but it's used to hedge that physical production. And what exemplifies or exacerbates this problem even more, David Morgan and I were talking about this the other day, is that if you really look at the industry as a whole, you go from the miners, you take that silver that's pulled out of the ground and gone through the entire process of, leaving the gate, going to a refiner or a smelter or a fabricator or a jeweler, down the list, scrap, wholesalers, retail dealers. Everybody, the moment they get that silver in their hand, not everybody, but a lot of people, the moment they get that silver in their hand, they want to reduce the volatility risk. So what do? They go into either the futures market or they try to hedge with the counterparty the price risk so they don't kill their profit margins. And so that chart actually does a great job of showing just how much 1 ounce of silver is probably oversold through the course of its life by the time it hits maybe its end destination. And hopefully that kind of helps a little bit.
So I pulled up the chart here. It was John Adams that had kind of published it, and it says if silver was only traded via Comex hours, it would be 19 cents an ounce versus the Asia trading hours trading at $227 per ounce. So is it possible that by separating these different places where the silver price trades, they're serving different functions as well? Like the Comex versus where it's being traded in, let's say, Hong Kong or in London?
I think it would be unfair to say that the price would be $200 higher than where it is today if we didn't have the Comex, because obviously what would ultimately happen is you just have hedging being done on a different exchange. It's just that the Comex has been a very prominent exchange for hedging. I mean, it's one of the most fluent or liquid exchanges in the world. So from that perspective, it's used by a lot of producers. It's used by a lot of banks. It's used by clearing firms or hedge funds or fabricators, refiners. They use that market to protect their physical inventory from potentially hurting their, losing the price, or the price action hurting their profit margin. That's really the essence of typically the futures market. The problem we run into as physical investors is we rely, or the market sort of looks at the futures market as price discovery, as that is where the price of the metal should be. And it doesn't give you the full picture, because in essence, there's a lot of selling that goes on that potentially, if you stripped away some of this hedging that happens, I'm not talking from the miner standpoint. The miner pulls that out of the ground. They want to make sure that they may have covenances on their financing, capitalization notes or debentures or debt or equity offerings that they have to hedge. They don't have a choice. But the problem is that same piece of silver, as it travels from the mine to maybe the bullion bank, or to some type of commodity trading firm, to a wholesaler, the moment that the next party gets that ounce of silver, they reflectively go ahead and hedge the transaction because they're worried about the volatility and the price action. So the selling that happens over time is multiples of probably the actual ounce that's pulled out of the ground, if that makes sense.
Yeah, absolutely. And that's kind of the point that I was trying to make, is that the Comex is used very predominantly for hedging, right? And maybe Jim, you can speak to this a little bit, because the Asian market, let's say, more used for physical delivery versus hedging more so than the Comex?
Tom, I'm sorry, I don't really know much about the Asian market on it. Mm-hmm. I will say that the Comex trades through Globex 23 hours a day. It ends on Friday at 5 o'clock. It starts on Sunday night about 6 o'clock Eastern. And so there's a lot of liquidity. There's, they're fixed quantity, fixed quality markets. And just like I'm sure Steve is going to talk about crude oil a little bit coming up here, and heating oil and gasoline, I kind of find it, crude oil can be $106. It's been to $140, I think, twice in my career, 140 plus. And then they complain that silver is only $21 or $22. I think silver is going to have its day. I think gold is showing us the way that silver will get there. In terms of answering your question, I don't really know what goes on in Hong Kong. There's also, I think there's a Shanghai Metals Exchange now too. And I kind of have my plate full with Comex and with Chicago Board of Trade and Chicago Mercantile, that kind of thing. One thing I would say is that just visit about your opinion about Comex being a hedging market. Mm-hmm. About 20 years ago, in the decade between 2000 and 2010, a lot of gold mines were hedged, and they lost a lot of money because the price went up real strongly. Once you hedge, you're fixing your price. As Bob mentioned, you're managing your risk, but you're not benefiting in the upside. I don't want to speak for him, but I will also mention that Mr. Neumeyer, from one of the big mines that people are familiar with, he's the head honcho. He's mentioned that if we do a fixed price contract with a company, if somebody comes to them, a big user, they say, we want a fixed price contract, it does the same exact thing. It locks them in and they can't participate upside. Mm-hmm. So that is one thing that the Comex exchange can do for people, both the suppliers, which might, I think Bob mentioned, would tend to be a natural seller, but also for a user, a big user that makes electric cars or makes solar panels or something like that. They would tend to be a user, and they would tend to be a long hedge or a buy hedger to protect the price. And what better than $21 unless it's, $20.95. But I think that people that are complaining, we started on about premiums here a little bit. There's Mr. Keynes has got a post out today, and I don't agree with it all what his opinion is. His opinion seems to be Comex is a false price. It's not a price setting. It's not the real price. The real price is what these dealers are getting for their silver. And if that's the case, why is Bob's price cheaper than some of the other dealers that are out there in the United States? Looking forward to listening to Steve. Thank you.
Thanks, Jim. Steve, can we test out your mic?
Yeah. Hey, Tom, can you hear me?
Yep, sounds good. Thanks for joining us, Steve. I'm looking forward to talking energy, Cliff, and all of these related things with you here today.
Yeah, it took a little while to get set up, but I think this is a great place to do this on Twitter Spaces. And I think the issue is, Tom, and I'm trying to get more precious metal investors and analysts to understand energy. It seems like the energy people could care less about precious metals. A lot of the precious metals people don't care about energy. And then you get the economists. They really don't care about precious metals or the energy. And so I'm trying to make people realize that it's the energy comes first, everything is second. And so now that we're hitting this energy cliff, when I used to talk about energy years ago, like 5 years ago, it didn't get much traction. But now we're starting to see the symptoms of us reaching the peak of energy capacity and production. And now as we start to go over the energy cliff, it's going to change the world as we know it. And unfortunately, the economists, the financial analysts, they have no idea. And this is the reason why it's important to be in precious metals. And let me just start off with some energy information. The global oil inventories, and this is mostly the OECD and the United States, is declined 20% since the end of 2020. It's down 714 million barrels. And so we're going to continue to see that drawdown. And then this is what's fascinating. Since the financial crisis in 2008, the global oil supply was about 87 million barrels. It peaked in 2019, before the pandemic shut down, at a little more than 100.6 million barrels a day. Then it dropped off like a cliff in 2020 during the pandemic shutdown to about 91. Now it's back up to about 98. But we've got Russia, about 700,000 barrels. They're saying that it's going to reach over 1 million and a half by the end of May into June. And so now we added 13 million barrels of production since the financial crisis. Most of that was the United States shale and tar sands, oil sands. That's where 85% came from. Well, that's most of that of the shale, and that's in serious trouble. We're going to start to see that decline within the next year or so, especially when the Permian peaks. So there's not going to be another 10, 13 million barrels of growth like we had since the financial crisis. So when the Fed and central banks tried to do whatever kind of QE, they had 13 million barrels of growth. You need the growth to actually, the QE could work with the growth, but when you do QE or money printing without oil growth, what you're going to get is massive inflation. That's where we're headed, and unfortunately, I've got a lot of data to show, but you can ask some more questions. The thing is, there is this idea that there's a spare capacity, especially from OPEC, but I think a lot of that's overstated. For example, Saudi Arabia supposedly has 1.5–2 million barrels a day of spare capacity, but the OPEC is actually down 2.7 million barrels a day, what their quota was supposed to be by this time. So they're not ramping up production, and Saudi Arabia's oil inventories are down 66% since 2016. They were like 330 million barrels. Now they're down to 130 million barrels. So it looks like they use some of this oil as like a spare capacity. And so when you look at this, and one last thing, the United States is doing the same thing. Our SPR is down almost 100 million barrels. Before the pandemic in February 2020, it was about 635 million barrels. That's what the SPR had. Now it's 538. That's almost 100 million barrels. And so this is what's happening. We're stuck
Steve,
now.
Let me interrupt you for a second. Maybe quickly explain what the SPR is and if draining it had any effect on price.
Well, that's
and
what they
when
want.
it's supposed to be used for. When it is supposed to be used.
Well, the Strategic Petroleum Reserve is underground salt caverns. There's 4 major ones, and most of those it's in the Gulf of Mexico. It's in the Gulf of Mexican states. That's where it is. Louisiana, Texas. That's where it's located. And unfortunately, a lot of this oil's been sitting there for quite a while. And when they try to pump it out, there's a lot of there's a lot of bad stuff that comes up with it. Impurities, so they have to kind of remove that. And so the issue is the SPR is Strategic Petroleum Reserve, actually for times of war. That's what it's supposed to be used for. What we're using it now is to help with the price. And that's what we're seeing throughout the world. We're seeing these inventories declining because they're trying to keep the price of oil really going up. And so now Biden says he wants to start adding back to the SPR. And I don't know how they're going to do that because look at the price of oil. It's $105. It didn't really help. It helped a little bit, but now if we try to add, it's going to go in the opposite direction. The price is going to go back up. And so I don't think we're going to be able to build that inventory that much. And so this is the problem. I've always said when you understand what's happening with the oil and natural gas inventories in the world, when you see those continuing to decline, they may build throughout the, natural gas is going to be consumed during the winter. Then it builds in the spring. It stops building in the summer when there's a lot of electricity for cooling. And then it builds again, supposedly in the fall. And then it declines again in the winter. We have those kind of cycles. But if we see a trend, it's going to trend lower and lower and lower. That's when we're going to have real volatile prices in natural gas and energy. And the United States is the lowest right now, natural gas prices. That's going to change in the next year or two. We're going to see huge increase in natural gas prices in the United States when U.S. natural gas production, shale production starts to decline. And so this is what the world is facing. And unfortunately, with this massive debt, Tom, we're in serious trouble.
Yeah, you and I have spoken at length before, even offline, in and around our interviews that we've done together about all of these issues. So, Steve, maybe I think it would be helpful to go through bringing up some examples of the EROI. I mean, you have that on your Twitter profile there, right? The energy return on investment. So give us a couple different examples of, let's say, shale oil versus Saudi oil, and what the actual energy investment versus what you get out of the ground means, and how the U.S. shale oil, whole system relied on QE and cheap interest rates to be able to exist at all.
Well, one of the objections I get from people who do not believe in peak oil, they said, well, they said this about the Club of Rome 1970s there's going to be peak oil. It never happened. And in 2005, there was going to be peak oil, and that never happened. Well, conventional did peak. The good quality conventional peaked. We just brought on a lot of crappy unconventional, and it's continued business as usual. So the thing is to respond
Steve,
to
let me just interrupt you again. Let's just explain conventional versus unconventional for those that aren't familiar.
Conventional is the high energy return on investment, and it is the cheaper to produce. All right.
So let's say five barrels invested, or 1 barrel invested for every 5 output, something like that. Where's that line?
Well, let's go back in history, and maybe if you've heard this before, the number is in the 1930s, the U.S. oil industry and gas industry, let's say oil, for every barrel of energy it invested into production, it got 100 barrels of oil. So that's an energy return on investment of 100 to 1. Those were the good old days. By 1970, the U.S. oil EROI had fallen to 30. Estimates of conventional by the 2000, it was about 11 to 1. And now shale is 5 to 1. Oil sands is 4 to 1. Saudi Arabia is probably 20, 30 to 1. But overall, when we look at the entire globe, it's starting to come down. It's right above a 10. And so this is the problem. It doesn't matter if there's a lot of oil to be produced. Our economy needs something north of 12 to 1 energy return on investment from our oil to sustain all this stuff that we have built up, all these different parts of the economy. So even though they may be trillions of barrels of crappy oil shale or methane hydrates, it's not economic. It would bankrupt the system. So we can't really access that quality of oil. And so that's where we're at, Tom. The conventional was very easy to produce, and it allowed us to have this wonderful economy. And now we're trying to continue business as usual with shale oil, with oil sands, and deep water. Now, deep water has a lower energy return on investment. It declines very quickly. And so this is the problem we're facing. And, another thing I want to say, too, I think the situation's worse than we realize because the U.S. Energy Administration Agency puts out a weekly estimate of U.S. oil production. And right now we're at 11.9 million barrels a day. However, their newest February monthly report, and that's the real number, it was 11.3 million barrels a day, but the weekly number back then was 11.6. So we're back in February, the weekly number was inflated by 300,000 barrels. So I think the shale industry is underperforming. And so now I think the situation is worse than we realize, even though we can still see some growth. But this is the problem. I've said this many times. The world was running at 100 million barrels a day in 2019, and that was it. We reached the peak. It's the amount of capital that it takes to continue pumping out 100 million barrels a day. It's unbelievable. And unfortunately, the capital expenditures by the major oil industries has been collapsing. So they're not spending the money they were a decade ago, back in 2012. They're not spending the capital. It's collapsed. So we're not going to have future production growth. And this is where we're at now. And so that's the reason why you're seeing all the problems in the world with high inflation, because when oil prices go up, when natural gas prices go up, it thunders throughout the entire economy, which is food, commodities, goods, and services are going to be extremely inflationary.
So, Steve, can you explain to us how the U.S. shale oil, kind of that whole system, really relied very heavily on debt to keep producing?
Yes, when Bernanke came out, we did QE. We lowered interest rates to about 0 or 0 to 2.25%, because you need to put debt. You needed debt to be able to produce shale, and that debt is still on a lot of these companies' balance sheet. So to service that debt, because you can't do it with cash flow or free cash flow, you need unfortunately poor suckers to invest in shale. And the only way you can do that is with very low interest rates, because it wouldn't be economic to do that with shale. And so we brought on 8.5 million barrels a day of shale, but we also brought on 5 million barrels a day of natural gas liquids. And so it was like 13 million barrels a day of this stuff. And that was all due to having interest rates really low. The problem now, Tom, is that the Bakken has peaked, the Eagle Ford has peaked, the DJ Niobrara in Colorado has peaked. The only thing we're waiting for is the Permian. And according to the data, once they go through 50% of their tier 1 locations, which is going to be this year, then the Permian is going to peak. And when that peaks, we could be at a plateau for a bit, and then the decline starts. And so if the United States was 80% of global oil production growth since 2008 financial crisis, and it depletes almost 50% a year, we're heading to what I call the energy cliff. And financial analysts, economists, even the precious metal folks, which, I agree, gold and silver is the place to be, but the one thing that is missing is the business cycle is going to be over for good. When the business cycle of expansion, the peak, recession, and then maybe a depression, and then you get another up, these cycles are over now. And I think the world hasn't realized that. And when the world realizes that, Tom, that's when we're going to see investors and institutions move into precious metals. And they haven't figured that out yet.
So how far do you think that is away from those institutions and big investors to start moving into precious metals?
That's a good question.
This realization of the business cycle being over.
Well, I've listened to some of these Twitter spaces and some interviews by financial guys. You've got the inflationists, right? We're going to go to hyperinflation, or we're going to go to serious inflation. And then you got the disinflationists or the deflationists. And they're both right and wrong. Because I think we're going to see more disinflation, and that's stock prices are going to fall. And then we're going to go into a recession. So we could see lower metal prices. We could see lower energy prices, because they're going to continue to raise interest rates, and that's really going to hurt the consumer. For a short period of time, we could see a disinflationary wave. However, the energy cliff dynamics come back to haunt us again. Like, for example, U.S. natural gas inventories, even though we're producing more natural gas than ever, is down 19% compared to last year. We're exporting a lot of LNG now. It's almost 12 billion cubic feet a day. We're exporting, a lot of it's going to Europe. And so I think, when does the institutions and when does investors, let's say retail investors that are not precious metal investors, I would say they're going to start waking up in the next 2 to 3 years, maybe sooner. Because right now, a lot of fund managers, they're still thinking Apple's going to turn around. They're still thinking Tesla's going to turn around. A lot of these guys believe this is not they don't believe this is a bear market. They believe we're going to see higher stock prices. I think we're going to see continued decline. And the number I hear is about 40% for the S&P Dow and about 50% for the NASDAQ. So when you have managers still holding on to these overvalued stocks, they're not even thinking about trying to protect their wealth. And that's the thing, Tom. The energy cliff is going to enforce investors and institutions from building wealth. You can't do that unless you have growing energy production to protecting it. And you can't protect it in stocks. You can't protect it in bonds, and you can't protect it in real estate. And again, I think we're going to see that in the next 2 or 3 years.
Steve, do you think that renewables have any place here to be able to make any type of a transition? As we have all heard that we're supposed to be transitioning towards more of a renewable or green future here.
Well, I just did an article post for my subscribers, the gold subscribers. Right now, wind energy is it's a disaster, because the larger wind turbine producers and even the wind blade producers are losing money selling wind turbines because the costs have increased substantially. You see, when shale was brought on, oil production increased and we had kind of a surplus. So oil fell from $100 a barrel down to 30 by 2016. And then it started going back up, 30s, 40, 50, 60. Well, this allowed for the ability to produce solar and wind. It was kind of economic, but now with $100 oil, $110 Brent, and natural gas prices, let me tell you, the natural gas prices are 4 times higher in Europe. And that's where That's where they're putting together these wind turbines. So it's not economic now to produce these wind turbines, and even the blades. The blade manufacturer, I think it's TPI Composites, they've lost money last year making wind blades. So this is going to transition into solar. So all this idea that we're going to ramp up all this wind and solar by 2030, I think in the next 2 years, it's going to fall flat on its face, if not sooner. And we're not going to be able to ramp this stuff up because we won't have the energy to do it, number one. And the prices are going to make it uneconomical. And also the supply chains are breaking down. Look at Harley-Davidson. They had to shut down production because they can't get parts. It's going to happen throughout the entire supply chain for renewables. Renewables are not a solution. They just make the situation worse.
I was reading a story the other day as well that Ford has stopped taking orders for F-150s as of, I think, this week or last week. They don't know when they're going to order or open their order book back up.
Yeah, thank you for bringing that up because I've got some interesting data on the global vehicle production. That peaked in 2018. The pandemic wasn't the reason it fell. It did, but it was 97 million units. That's all units, all vehicles in 2018. It fell to 92 million in 2019. So it already fell 5 million units before the pandemic shutdown. And then it fell to 78 million units in 2020. 2021, it bounced up to 80. And then the SP Global was forecasting a nice jump this year. They were suggesting we would reach 83, possibly 84 million units. Well, they just did an update as of April. Now it's down to 80.6. We can't even add a million, and that's going to be downgraded even more. It may fall below 2021. Now, why is this interesting? Because if we go back to the financial crisis, remember, it was a bad thing. The stock market crashed, and we had the shutdown, basically, of the market. In 2007, global vehicle sales were 73 million. They fell to 71 million in 2008. Then they dropped to 62 million in 2009. But guess what? In 2010, they reared back to a new high of 77 million. So they increased 15 million from 2009 to 77. We're at 2021, now at 2022. We're supposed to make a recovery. We are going to be 17 million lower than we were in 2018. That just goes to show you, is it all China being shut down? No, it's just that now we're part of that. That's part of the issue. When you have a peak in energy production and now it's starting to fall, that just means less goods and services. And so as energy production continues to decline, Tom, we're going to have lower and lower goods and services and then more unemployment.
Steve, do you foresee this being kind of a slow reduction or a slow roll off in production? Or is it, when we use the verbiage of a cliff, is it going to be a literal cliff kind of that just comes out of not necessarily nowhere, but is it going to be more dramatic?
Well, and that's my analysis on the energy cliff. That's my famous, the energy cliff, which is very similar, copies the Seneca cliff. The Seneca cliff was by Lucius Seneca, and he was, he was an ancient Roman philosopher. And he said this before the Roman Empire collapsed. I believe he died in 65 AD. The Roman Empire didn't collapse until 300, 400 years later. But he says that the economy or empire, that the increases are sluggish growth, but the way to ruin is rapid. And when you look at a lot of the past civilizations, that's the way it tends to happen. And so now that we've added all this debt, what we have done is we have pulled production from the future forward. We've increased the annual amount to 100 million barrels a day. And now the declines are going to be very swift. And so, for example, in 2012, when the oil price was 110, the top oil companies upstream capital expenditures, that's oil and gas wells, was 170 billion. Last year, it was 56 billion, and the price of oil was 83. This year, they're estimating it may get to 70 billion, with the price at 110. It's 100 billion less than when it was a decade ago. And if we adjust it for inflation, to have the same capital expenditure based on $110 oil, these companies would have to spend 214 billion, and they're only going to spend 70. It's a third. This is the problem, and maybe it's due to the green energy, the ESG. Everyone's poo-pooing oil. Let's forget all that. Let's say we don't have those people or the government's telling you can't produce more oil. There just isn't the oil to produce. That's the issue. There may be a little bit more if we didn't have all the problems with ESG and all these policies. There just isn't that much more to produce. So what I see cliff-like declines, stabilization, then cliff-like declines, stabilization, then cliff-like declines. And so we could see by 2030 a huge decline in production, and then by 2040 it could be half of where it is now or more. Half. And you're talking about a world no one can recognize.
I was having a conversation the other day, Steve, with somebody that was that kind of disagreed with your thesis a little bit. And I guess the main point that he was kind of bringing up is that he didn't believe necessarily that there was such a lack of resources at this point. So do we have any visibility into, for example, what kind of resources or underground reserves that haven't been tapped yet in, let's say, Russia particularly?
Well, if you look at some of the Russian analysis, even the Russian oil minister, Russia was going to peak in like 2023, 2024. You see, they're doing horizontal drilling to access a lot of their oil in the eastern part of Russia. They've been doing horizontal drilling. It's different. They're not fracking, but that's how they're trying to. It's called enhanced oil recovery. And so we're spending a lot of money to get more of this oil. And the Saudi Arabia is the same thing. You see, what Saudi Arabia has done, especially in their Ghawar, which is the largest oil field, it was producing 5 million barrels a day. Once it started to peak and then you had to pump it out, they decided to put these water injection around the outside of the field, and they would inject water. And what that does is it pushes the oil, and the oil would come out of the well. And then they have these gas oil separation plants. They're all over Saudi Arabia. And so they have to take all this water. Well, they were doing fresh water. That became expensive. So now they're doing salt water. And so the issue is they're depleting their field from the bottom up. And every time they have to shut in a well in Saudi Arabia, and they drill it a little bit higher. So it's oil moves up to the top of the field because oil is lighter than water, especially salt water. And so this is the thing. Again, there's this idea. We've got oil shale in Utah and Wyoming. I mean, there's trillion barrels of that crap there. But Shell and I believe Chevron both, they just abandoned oil shale production in Wyoming because it wasn't economically feasible because oil shale is less than 2 to 1. So even if you decided to spend $500 billion or $1 trillion setting up this massive oil shale operation in Wyoming, its 2 to 1 energy return on investment would not allow an economy that needs at least 12 to 1 to function. And that's where you get these people on the resources. There's methane hydrates, there's oil shale, there is other means of resources, but they're really not economic for us to produce to allow our economy to function. And then, I mean, let's just talk about the debt now. I said the debt has allowed us to increase production more than it would have. In 2007, the top 5 oil companies, this is Exxon, Chevron, BP, Shell and Total, their total long-term debt was $64 billion. Last year, $232 billion. It has fallen a little bit since 2020, and they may lower that a little bit more, but their debt is up, it's quadrupled in the same period. So this is the debt that was used to continue adding this production, and now we have to try to maintain it. And I would be proven wrong if by 2025 we're not starting to see decline, and by 2030, I say U.S. oil production, shale production is going to be down 50+%, and global production is probably going to be down 10 to 15 or 20%. And if I'm wrong, then we can go back and look at those numbers and say, well, I was wrong. But I think the popping of the debt bubble, because it can't be managed with the energy now, you can only sustain high debt levels and interest rates with growing energy production. If you have stagnant or falling, the whole debt bubble falls apart. And that's the other issue that's going to pull the oil production lower. Because what is economic will no longer be economic.
Right. And I think that's maybe the most important point to highlight here, Steve, is that we need a certain amount of return on investment for these barrels of oil that we're pulling out of the ground. Yeah, it can be harder stuff, in other words, almost like lower grade or harder to get to, harder to separate, more energy intensive to get that oil. And this economy has functioned on basically the easy barrels to get, and we're running out of that grade of oil to be able to recover, right?
Yeah, and to put into perspective, because I like to, the United States is the largest consumer of energy. We're consuming about 20 million barrels a day, and that's about a fifth of the world's oil or petroleum production. So we're consuming about a fifth, and we only have 330 million people of the 7+ billion. Now, I've said this statistic: what the U.S. took 100 years to do, to grow to a giant economic suburban metropolis, China did it in 20 years. China, and I've said this statistic, what the U.S. cement production in 100 years, China did it in 3. China has become kind of like the Walt Disney World on steroids. They have all this infrastructure, and now it's all these people from the rural areas have moved into the city, and China, people think China is going to be the next great empire, economic power. No, they're going to have trouble just maintaining what they have. So China is in serious trouble. And so I think these are the issues that people don't realize because they don't look at the energy.
Sorry, Steve, is that because China doesn't really have very much of their own domestic production, and also they also import so much energy?
Yes, it's about 3 to 4 million barrels a day is what China has. They could go into shale. They've tried doing some shale. It wasn't economic. China is the global goods producer, mostly due to coal. They have a lot of coal. So they import a lot of oil. And then we have to remember, people say, well, Steve, this is what I get too, Tom. Well, we'll just go to nuclear. We'll just go to thorium. We'll just go to coal. We'll just go to natural gas. And what they failed to realize, to allow coal production in China and the world to be at such a high level, you need diesel equipment to actually extract the coal from the mine. Then you need trucks to transport it to either a train or a barge. Then you need a train or trucks to transport that coal to the coal plant. That's all diesel. So now we're starting to see problems with diesel, right? We got Russia was actually exporting a lot of diesel to Europe. And now due to the war, Europe and the United States has done all these bans on Russia. And so it's a gun that's pointing back into the West's face, because they're hurting themselves doing these sanctions. And so when you have it's not the gasoline that's so important, Tom. It doesn't matter how many people go to Walt Disney or Walmart or Starbucks. It matters how these goods are transported, and that's diesel. So when diesel gets into trouble, the global supply chain gets into trouble, and you can't make a thorium reactor, you can't make a nuclear reactor, you can't produce more coal unless you have fossil fuels. Because all those things need fossil fuels and a very highly complex supply chain to make them, because we can't even do one nuclear power plant. Now, people can say that was due to the inefficiencies of government and policies and overregulation. But let me tell you, the regulation keeps us from doing stupid things like, things that happen, in Fukushima or, Chernobyl. So it's important to have these regulations. A lot of these parts come from all over the world, especially China. That's the issue. The entire supply chain is so interwoven that you cannot make a nuclear reactor unless you have a very functioning global supply chain that's fueled by liquid fuels, not electricity. We can't go to nuclear because nuclear is electricity. It doesn't run the global supply chain.
Steve, can I ask a question, please?
Yeah.
Okay. I see James Anderson is in the room too. Let's say I buy a box of silver from James Anderson's company that he represents, and a box is 500 ounces. And let's say that out of each ounce of that silver that I'm buying, 20% of the cost of the product was petroleum, diesel. Okay. Can I ask simply, Steve, if the price of diesel doubles, that 20% of that silver cost now has gone up 100%. That's increased the cost of production for that silver. Can I directly estimate that then that in, let's say, 8 years when it doubles, if the price of that diesel doubles from $5 a gallon to $9.50 or $10 a gallon, silver cannot be sold or won't be sold below the cost of production? Could I infer from that a durable product like silver or gold coin is going to rise to the new cost of production?
Jim, excellent question. Yes, and there's two ways to answer that. First, I'm going to answer that by the cost of production. And there's this theme about, a lot in the precious metals of the manipulation of gold and silver. I think the real manipulation of gold and silver isn't in the manual, it isn't in manipulating the price by some big traders and banks hammering it. I don't believe that. I think the manipulation, rather, is the stupidity of the market, which have invested in stocks, bonds, and real estate. And so that's where 99% of the market is invested. Well, that works when you have increasing energy production. That's where the asset values are. But now that's over. And so the world hasn't got the, I call it the come to precious metal religion yet, because they still believe in business as usual, infinite growth forever. According to my analysis, Jim, the primary silver miners, they're hurting more than the gold miners and the base metal miners. From my full cost analysis, it's over $20 to produce silver in the primary silver miners. Over 20. It may be closer to 21. Now, when you said 20% of the diesel cost, it's true, it's a little bit more for gold, but the raw energy is one cost. But Jim, the important thing to understand is it's basically 90 to 95% of the cost of producing silver is in energy in all forms and stages. Because if you have a Caterpillar haul truck that extracts the ore, it comes at a capital expenditure, so it's not energy. But I can tell you from the beginning of when they mined the metal and all the materials to produce that haul truck, to manufacture that haul truck, if you take it back to its common denominator, that $2 million haul truck, 90 to 95% of the cost of it is energy in all forms and stages. Labor, right. Electricity.
You're right, Steve. And don't forget even the tires that are on that big truck. It's all energy.
That's right. So here's my thing. Yes, as energy prices go up, the costs are going to just balloon through the entire system, because KGHM Paleska is the largest silver producer in the world. It's a Polish copper mine, and they have 40 million ounces of byproduct silver. I've been looking at their data. Because Europe is now, the cost of electricity is so high, the profits there are really declining for copper. And so people say, well, they produce silver as a byproduct. It's like a waste. No, it isn't. They need that silver revenue to fortify their balance sheet. So they're not producing silver for free. People who think it's totally ridiculous. We're seeing this happen more and more, but the cost of production is going to increase. The big move in silver, Jim, is going to be when institutions, mostly, because they control 80% of the funds in the market, and then investors start to move into precious metals to protect wealth. And that is going to push it much higher above the cost of production, because I see production of metals starting to decline, even if gold goes to 3,000, 4,000, because you're not going to have the energy to produce these metals in the future, or at a much lower level. And so that's another bullish reason to own the precious metals.
See that, guys? It's a good thing there is a paper market to trade derivatives.
Seppo, do you have a question for Steve?
No, I don't have a question for Steve. I actually know Steve from private correspondence for some time. And I would just tell you guys that if you go to my profile, you can get a link to a video I did a couple of months ago on this world energy situation. And they all touch on what is happening with the oil production in OPEC countries, as well as the shale and so forth. So I don't really have much more to say except to reinforce what Steve has just said. We are in real trouble, and it's coming at us as we speak. Thank you.
Well, Seppo, thank you. You know, I've been following a lot of the oil guys, Jean Lahira in France, who, if I pronounce his name correctly, I mean, he's over 90 years old, and he's been looking at the oil production. And so there's two ways to look at what's happening. We can count barrels, and we can see what the barrels are going to be. But then there's also the energy return on investment that's falling. And then there's another aspect which is really misunderstood. There's still a big question mark about the thermodynamics of oil depletion, because for example, we think that the shale industry is going to be profitable at $110 oil. Well, the cost to produce pipe, the cost to transport fracking sand, all these things go up significantly now with the price of oil being up. So even though some of the shale companies and some of the majors are making some profits now, wait until these costs start to move in the next several quarters. And then the availability of steel, the availability of water. See, it's getting very dry in the West. And one of the biggest producers in the Permian is in New Mexico, part of the Permian. Well, I mean, we're seeing fires already in the West. And the amount of water that is needed to frack these wells is astronomical. And then they have to, the water that comes out, it has to be transported and then re-injected in these deep water wells. And I saw a very interesting picture. Some of this water is coming out of the ground as a geyser, right? In Texas, and it's salt water. So it looks like it's amazing. And that's why they're having a lot more earthquake activity, because the water is lubricating the geology down in the ground, which is causing more earthquake activity. So, I think that the world is facing a peak in production, and we have no idea what that looks like on the decline side. We have no idea. And if you add the U.S. and West getting more involved in the Russian-Ukraine war, and then something happens in Taiwan, this could be very interesting, very dynamic. We could see a real breakdown in the global supply chain, and wait to energy prices and precious metal prices then. I mean, that's going to be, I'd say we're going to see real volatility in the precious metal prices and energy in the next several years. Let me answer your question. I know Jim had asked about the percentage of energy in an ounce of silver. So what you're asking, Bob, is what is the turnaround for bringing on more a shale well?
Yeah, shale or even in the Gulf or pretty much anywhere.
Well, to bring on a shale well is very quick. I mean, you can drill and complete that within a month, and then they're not just doing one; they're doing 4, 6, or 8 wells right there in the same location. Now, to go to Gulf of Mexico and to do a deep water or ultra deep water, that can take 5 to 8 years. It takes a while to get the capital expenditure, the drilling, then the setup. You have to drill it, then the setup. It could take many years to do that. So that's the reason why we saw a lot of the energy industries, the companies move into shale, because it was quick turnaround. The problem now is that it comes down to the tier 1 locations. Like, for example, the first shale gas well or field in the United States was the Barnett in Texas. When it reached 50% of its tier 1 locations, and these are the best locations, it peaked. So that is kind of that is the indicator to know when these are going to peak. And that already happened in the Bakken, Eagle Ford, and DJ and Alberta, and that will likely happen in the Permian. And some analysts I've been looking at are suggesting that U.S. natural gas, which has mostly been, the growth has been the Marcellus and the Haynesville. Marcellus is in the northeast, Pennsylvania, New York, and West Virginia, and the Haynesville is in the south. It's in the Gulf of Mexico, Louisiana. They're probably going to peak in a year and a half. And then that's it. And there's really not much more. There is some in Africa and there is some offshore, but with the declines coming, and then if the debt starts really imploding, and that's a factor that we don't realize. The debt is really going to pull down the economics of energy. And then we're going to have less. You see, you got to remember this. When oil production falls, you have less people working. There's less people working goods and services, less people to afford the energy too. So it's like a double-headed sword. Now, Jim, you had mentioned according to what I've seen for the primary silver mining industry, if it's an underground mine, it's energy. Diesel is about 15 to 20%. Then there's electricity, which is to mill the ore. But now for the primary gold mining industry, they spend a lot of diesel on moving about a gram a ton of gold to get that. So it's about 30%. It's 25 to 30% for liquid fuel. And then that's not including electricity. But then you got labor and all the costs, because they use limestone. They use a lot of they use lime. They use all this different materials. Well, to produce the material, to transport that material, to get it to the mine, and if you go back to its beginning, it was the energy to get that material there. That's what it is. And that's really what it is for every good and service in the world. It's really the energy and labor.
Steve, I think you and I have spoken before about the complexity of some of these supply chains. Was it us that talked about the super or semiconductor supply chain, that it's something like 20 countries have to contribute individual ingredients to make a chip?
From the data I've seen, it's over 50. It's over 50. And what's interesting, because the semiconductor, there's people that, first of all, in the United States, there's a company that will design the semiconductor. And this semiconductor, by the time it gets into a smartphone, it has traveled 2,500 miles. There are many different countries that supply, I call it, if you look in Taiwan Semiconductor or any massive fab plant, next to the fab plant is their own specialized gas facility, because to make a semiconductor, they need specialized gases that are 99.99% pure. So when you look at the piping and all the infrastructure to make a semiconductor fab plant, it's massive. But now it's built, it is supplied by a massive global supply chain. Companies in Europe, companies in Malaysia, and materials from all over the world. For example, many of you heard this, more than half of the neon gas is refined in Ukraine. It actually comes from natural gas in Russia. They refine it in Ukraine, in Odessa, and then so about 75% of the neon gas in the world is semiconductors. That's how we etch the semiconductor. And half of it, or more than half of it, is in Ukraine, and that's shut down. And so I think this is the issue. It's so expensive to produce neon. Most people who produce natural gas don't do it because you got to get it to 99.98 or 99.99% purity. It's just not economic to refine it. So the issue is all these different countries have a little bit that they supply. So if you say, well, we're just going to do it all in the United States, it can't be done. You cannot regionalize a very high complex system just in the United States. Because we need, unfortunately, some slave labor in Indonesia to produce one of the parts that is necessary. And so this is the problem. And one last thing, the lithography machine, the EV lithography machine that actually imprints the semiconductor, they come out of Germany and the Netherlands. Germany makes the lenses. The Netherlands makes the machine. This thing has got 50,000 parts in it. And they get those parts from a lot of different manufacturers in the world. They don't manufacture all those parts right there in the Netherlands and in Germany. And so that's the reason why Harley Davidson has shut down production, because they can't get the parts. And so we're just beginning to experience the shutdown of the global supply chain. And again, as I mentioned, and I'll stop here for any more questions, if we see an escalation of the West into Ukraine, and we see more problems with Taiwan, with China and the United States, the supply chain could really break down.
You've shared with me before, Steve, too, about when civilizations get very complex, that is also kind of a marker of when they start to fall, right?
Yeah, Joseph Tainer is a professor in Utah, Logan State University, and he's famous for the collapse of complex societies. And you can go on YouTube. He's got a lot of these lectures. They're an hour or 2 hours long. And it's really common sense if you think about it, because technology isn't more efficient. It just uses more energy. And let me give you an opposite example. The native Hawaiians had these massive fish ponds before the Westerners came, England or the United States. And they had these big fish ponds. Their energy return on investment of the protein was 100 to 1. And so, but there wasn't much technology there. It was very simple. It was management. They just used it in their advantage. Our modern high-tech farming supply energy return on investment, it consumes 10 calories of energy to get 1 calorie of food on the dinner plate. It's a massive energy loser. So technology isn't more efficient. It seems like it's more efficient because we've had the oil that allowed us to do all this stuff. So right now, as you add more complexity, and people could tell you, a lot of this stuff doesn't last long. And maybe they say, well, it was built that way, but no, a lot of this stuff breaks down easily, because a shovel, a nice, well-built shovel can last you a generation if you take care of it. If you even replace the wood handle, the steel shovel will last you a generation. Geez, an Apple phone or a computer, you get 3 or 4 years out of it. That's good. And so high tech because of the heat that goes through it, it just breaks down quicker. And so the more of that you add to the system, the more of it's breaking down. And that's one thing we don't realize. The global supply chain, high-tech global supply chain, is just breaking down at a very fast rate, and we have to keep replacing it. And that's the issue. And I've meant this, I've said this before. A Bitcoin miner lasts about 2 or 3 years, but what's even worse than that, a banking server, well, all the digital banking we do, lasts about 4 years. And if you don't replace those things, you don't have a digital banking system. And again, these are things that the people we're not paying attention to.
Seppo, you had your hand up there a little while ago. Did you have another comment?
Yeah, I did. Well, Steve, also investment in the oil business, and then, but I have read that many of the oil companies have shed their upstream staff. I think Shell went from 700, maybe it was BP, they went from 700 down to 100. Now, the question one has to ask is that why are they doing it? Is it because of the ESG pressure? Or is it because of some of these CEOs are taken to courts for polluting the atmosphere? Or is it because they're not just finding enough oil? Well, as you know, I think you read that the decline rate in the large oil fields in the world is about anywhere from 3 to 4.5 million barrels a day. So that is actually what we would have to add in order to keep the production flat. In addition, we have to add an extra billion because of the population increase. So, I mean, I completely agree with you. I think we are on this cliff. And, you know, there's the old saying that the so-called Pareto principle, that the first 80% of the product gets done with 20% of the effort, and vice versa. The last 20% takes 80% of the effort. So this idea of a decline, faster decline, is certainly in the cards, and I completely subscribe to that thing. Now, the only question basically is how can we protect ourselves from it? That's an important question, or discussion which we ought to have. And you know, okay, you guys talking about precious metals. I mean, I have some few gold coins, but basically because I read that during the Great Depression, people were losing their houses because they can't pay their taxes. So, you know, I'm preserving these few coins in order to pay my taxes in future years. Thanks.
Seppo, you bring up a good point. And if we go back to the 2010, 11, 12 period when the oil price shot up to over $100 a barrel, we saw the major oil companies, as you know, rightly know, they were investing a lot of money. And I quoted this figure that the top international oil companies were investing about $170 billion in the upstream oil capital expenditures, $170 billion, the top ones. This year, it's going to be about $70 billion. Now, the thing is, all that capital that was invested in 2010, 11, 12, 13, 14, we realize if we look at the increase of new discoveries, especially conventional, it didn't do much, right? Conventional oil discoveries, which is the good quality oil, really didn't increase. As a matter of fact, they've been steadily declining. So I guess the oil industry has to deal with the governments and the ESG and the supposed move to green energy. That's part of the issue. But the real issue is the oil industry executives realize there just isn't the economic oil out there because they spent 5-6 years with a lot of capital expenditures and they really didn't get anywhere. And so it's just gotten much worse. And now what they're doing, they're cutting their capital expenditures. They're getting a little bit more free cash flow. They're trying to pay down debt. They're trying to pay dividends. And now we're supposed to move to green energy. And unfortunately about green energy, and then I'll get to your question about what do we do. All this wind and solar that was added, the wind turbine will last about 15 years because the maintenance by year 15 becomes more expensive than the energy that it's producing. Now, if the price of energy goes up, that might be a little bit different, but the wind turbine and even the blades get eroded, they have to be replaced. So a natural gas plant, power plant will last 50 years. Some coal plants can last 75. So there you go, high-tech wind turbines, they don't last about 15 years, these very high-tech turbines, wind turbines, and then the solar panels, 20, 25 years, and then they really start to degrade. So even though we've added all this stuff, when energy production really gets bad and declines in 10, 15, 20 years, we're not going to be able to replace all this green. And that's a double whammy. We're not going to have the energy from this green energy we have. And so, and to answer your question about what do we do, gold and silver, it will not provide you food. However, it may provide you food if you have the coins available. Of course, gold, you can't eat gold and silver, and people tell me that. But yes, gold and silver may provide you food supplies where people would want gold and silver than worthless paper money. So that's one thing. But the other thing is, the only choice that the world faces right now is degrowth. It's going to come whether we manage it or whether it's unmanaged chaos. If we manage it, then we can degrow out of the declining energy supply in a managed way with governments. But if you look at what's happening with governments now, they're not behaving. This is mankind. And so it's going to be unmanaged, chaotic degrowth. And so it's important that people grow their own food. It's important that people get out of debt. It's important for people to consider maybe moving to the country. If you can't get to the country, maybe family lives in the country, because I believe the suburbs and the big cities are going to be very problematic. It's going to be very hard to survive there. Not next year or the year after, but we started to see this during the pandemic shutdown, which forced people to say, hey, if they shut down the city, I can't get food, which they're doing in China. Well, they can't shut down the country. You could still live out in the country on an acre or a half an acre, grow some of your own food, or you could trade with a local small farmer. And so to me, that's where I see the world is going to go from a high-tech global supply chain to regional and more local. It's going to be forced on us. Either we prepare for that or it happens unexpectedly, and that's unfortunate for a lot of people.
Steve, how do you see the situation in China right now? Do you think that they're managing these COVID shutdowns in such a way that they're trying to really throw a wrench into the supply chain issues?
There are many ways to look at what China's doing. First, they're underreporting. They have been underreporting their real cases and deaths. You don't shut down Shanghai of 25 million people with 30,000 cases. But that's just silly. So either the cases are much worse or the deaths are much worse, but I don't think that's the case. I think the problem is when China decided to become a metropolis in 20 years, if you look at shale production, it's like gone up exponentially. That's not sustainable. Nothing that goes up exponentially is sustainable. It comes down in the same factor, the same way. China has grown exponentially. And so now they have to maintain that, and they really don't have the energy to do that, Tom. And so I think what may be happening, this is just my speculation, because energy prices have gotten so high that really hurts China, because they need very low prices, because they moved hundreds of millions of people off the farm into the city to work. And they have to continue employing those people, or they're going to be rioting, and the Communist Party is going to have serious trouble just trying to maintain. And I believe they've got 10 million Chinese who just keep surveillance and control of the Chinese population. 10 million Chinese control the Chinese population, but that's not going to work for long. So it almost makes sense to me that they're doing this to really cut down demand. And now they're trying to reopen it. And that's another problem because all I see is China is in serious trouble because they're not going to be able to maintain their system for much longer. It's going to collapse so quickly that people don't see that coming.
Well, and your point about energy is interesting because maybe about 6 months ago, I interviewed Chase Taylor from Pinecone Macro, I think his firm is called. And he brought up the point to me that when China recognized that they were having a real energy issue, they foresaw that coming. That's when they kicked out a bunch of the Bitcoin miners, and not necessarily because they didn't like it or whatever. There was a million other reasons for it. But when he brought the energy idea into it, I thought that was a really interesting explanation for it.
Yeah, from what I understand, the Bitcoin miners at the peak were consuming 1 to 1.5% of China's electricity. That's a lot. The issue is China is producing and consuming 4 billion tons of coal a year. It's going to be more than that this year. Two problems. Their coal mines were more closely located by their major cities. Unfortunately, a lot of these coal deposits have been depleted, and they had to move them further away. So now you got to truck this stuff. And there's this famous picture, I call it the Mongolian to China coal truck line. And it's hundreds and hundreds of trucks all in line moving coal from Mongolia to China because it's not economically viable. They tried to make a train. The problem is to construct a train through Mongolia with the volatility in the climate, it just wouldn't work. So now they've got these trucks hauling this coal. China consumes and produces 8 times a year more coal than the United States. That's how much it is. It's just truly enormous amount of coal. So they've got to do that this year. They got to do that next year. They got to do it the year after. And at some point in time, when diesel becomes in short supply, they're not going to be able to maintain that coal production because coal is not magically transported by the energy tooth fairy. It's done the old-fashioned way by diesel equipment. No, and so I think that's the issue. China and the Belt Road, the Silk Belt Road, it was a nice idea. They're still building a fast train from China to Russia, but it's like a boondoggle. They're not going to have the energy to support that. And lastly, I've said this a few times, but if there's new listeners, our major rail yard in the United States, in Chicago and Detroit, there may be 10 or 12 railroad tracks. China has a 20 railroad track high-speed rail station. 20 rails of high-speed rail. That's just how it's mind-boggling because it costs 3 times the amount of energy to construct a high-speed rail and to maintain it. And they have a huge 20 rail system, and that's just one. So watching the collapse of China, it's going to be unfortunate because I have no ill regard to the Chinese people. I think the Chinese people are like most people in the world. They're good people. Most people in the world are good people. It's the politicians that screw everything up.
Steve, what are some of the constraints right now on diesel fuel and kind of the issues that are driving the cost of diesel fuel up right now?
Well, the problem was we lost about 750 or 1 million barrels a day of diesel fuel from Russia going into Europe. And then just the decline, when you have a decline in oil production, you're going to have decline in diesel. Now, What's interesting, the United States, the East Coast is seeing the biggest decline in diesel inventories. It's the lowest in 20 years because some of that diesel was coming from Russia. And so now the East Coast and the Gulf Coast in the United States have the lowest inventories. It went up 1 million barrels this last week. But the reason why it's been falling is we're exporting more diesel. A year ago, we were exporting about 1 million barrels a day of diesel. In the last several months, we've been exporting 1.3 million. So Americans can thank the domestic energy industry for exporting this diesel to help other countries. So that's what's pushed the price of diesel up. And it's free market economics, right? If we want to believe in free market economics, then if you're an energy company, you're going to sell that diesel to someone else, to another company in Europe that's going to pay a lot more for it. And so that's what's happening. So at some point in time, Tom, the diesel is going to get much more problematic. And I will see a time when countries are going to have to start saying, okay, we're going to cut back exports. We have to really focus on the domestic economy. That hasn't really happened yet. We're still trying to help each other. But I think soon Americans and other people throughout the world are going to say, wait, you got to stop exporting all this good energy or these things because we need them. And we're doing that with natural gas and we're doing that with oil. Matter of fact, 3 million barrels a day of our shale oil is being exported to foreign countries.
And that just kind of adds more to this deglobalization trend that we're seeing now, right?
Yeah, the idea that the elite, there's the elite boogeyman out there that's going to, I hear about dirty bombs. We're having a dirty bomb practice run, in Texas. And so the thing is, conspiracies happen. I believe in conspiracies happen. The problem is the elite, they survive on the little bit of profit they get from the 7 billion people. So it's in their best interest that business as usual continues, even though people think the elite want to depopulate, because the elite need all these billions of people working to provide these high-tech things. You can't have them unless you've got billions of people doing this. It doesn't matter what the elite do or do not do. So I don't focus on what the elite or Bill Gates or the manipulation of the metals. I focus on the energy because the collapse of energy production is a guarantee. What the elite are going to do or not going to do is a chance. And they could shut down more of the economy, which would make the situation worse. So I think this is the issue that is facing us. The energy is bad enough. But if we get politicians and the global system starting to lock down to protect itself, that's really going to impact the global supply chain. And unfortunately, I don't think the market realizes how bad that will be.
1001 Nights, you've had your hand up patiently here for a little while.
Yes. Hi, can you guys hear me okay? Yep. I had a question for Steve. Considering people have been talking about peak oil for quite some years now, and books have been written on it, like Twilight in the Desert, for example, in terms of the data, what type of projections, like big firms like IEA, what type of projections forward do they think of probable reserves do we still have available? And how do you reconcile that with books like Too Much by Half, for example? In other words, are these rigs like audited, like in Saudi Arabia? Do we have like accurate data? Thanks.
Great question, and we don't. This is people say, I had a few people when I put out this, Nate Higgins did this wonderful chart about the energy cliff. A typical peak oil is a bell curve. Not perfect, but that's what it looks like. It goes up, rounds off, and comes down. But using debt now has changed that profile to where it's gone up much higher. It's pulled production forward, and then you get more of a cliff-like decline. Now, we could say that's a theory, and that may not happen, but it has been happening. Because I've told you, the global debt on the top oil companies has quadrupled. And I don't think they're going to be able to pay a lot of that debt down, or even the shale industry. So the problem comes down to when James Dietrich did that book, Too Much by Half, he is an oil reservoir engineer. That's different than an oil geologist. An oil reservoir engineer, to my best of my knowledge, understands how much oil is in place and what can be economically extracted, and using certain kind of techniques to get that oil. A geologist looks more at the oil in place. So what James Dietrich is saying is that a lot of the industry, what is actual reserves, let's forget about OPEC for now for a minute, these are too much by half, or he believes he thinks they're about 30%. That's what the number I get. It's about 30% overstated. And then if we include the overstated reserves in the Middle East in the 1980s, because they could export more if they had higher reserves. Now, Saudi Arabia, Iraq, Iran, Kuwait, UAE, all these countries really inflated their oil reserves. They didn't really do the drilling and exploration for it. So those are still on the books. So when you put all this together, it's hard for me to say, okay, Steve, you don't know when the energy cliff's going to hit, because there's a few variables that we don't know. But I believe the variables are much worse. So the number I give is 2025. That's the number I give, plus or minus. And it seems now it's going to be more minus. And it's been 14 years since the 2008 financial crisis. So what's a few years if we're off? 14 more years, it's going to be a total different world, a totally different world, because we're not going to have 13 million barrels a day of production growth. We're going to barely get back up to 100, maybe a little bit more, and then it's going to start to come down. And especially if we get escalation of wars in the world, resource wars, and then shutting down of resources in the global supply chain. Because if we get more shutdowns of the global supply chain, there is pipe to frack these wells that's coming from China. So we need to understand that if we can't get the drilling pipe, you're not going to be able to ramp up shale production, or at least get it up higher than where it is right now before it starts to collapse. And so that's the issue we face. The reserves have been overstated, and that is, lastly, those are barrels of oil. That doesn't include what the energy return on investment says about those remaining oils. Those remaining oil barrels it could be anywhere between 600 to 100 billion to a trillion barrels. The energy return on investment of those remaining barrels may be too low. And that's another issue that's not even considered.
So, Steve, we had a question come in here. He said, you think the energy has anything to do with NATO versus Russia, China, India, Africa, Arab world, and Latin America? The U.S. needs more people on their team, and none are to be found. Pay for gas in gold. Just do it. So, I had Luke Groman on the show a couple of months ago now, and he really walked us through what it meant for Russia to be demanding payment in rubles, and or if they went to demanding payment in gold, for example. So how do you see that whole situation developing for energy? Is that just in some ways a short runway?
No, you see, if we go back in history, we look at the late Bronze Age and the ancient Roman Empire, and you see that money was tied to energy. And so what people don't realize, back up until the 1700s, it was wood fuel. That's what these civilizations expanded on. They just cut down billion. I think in the peak during the peak Roman Empire, in about a 50-year period, they cut down 1 billion trees. Because you take the tree, you make charcoal, and then you smelt the silver, the gold, the lead, the copper, the iron. And that's just the metals. And then you've got to figure out the construction. You got to figure out wood for heating and cooking. And then for warfare, it's easily 1 billion trees. So what happened was the peak of the Roman Empire happened to when they could no longer access enough wood to maintain their bloated empire. And so this is what we're facing today. And so now we went to a paper money system because the dollar was basing it on the energy. That's what it is. We're basing money on energy. The problem is that worked for 100 plus years, even though there was inflation and money printing, because energy production continued to increase, mostly due to oil. Now that's peaking and declining. The idea of the money valuing the system is going to come into question. And one of the aspects that needs to be understood, the M2 money supply is almost 22 billion. I think the currency in circulation is like 2.1 billion. That's not going to really be inflationary, because even though there's a lot of $100 bills in different parts of the world, a lot of that currency is kind of circulating throughout the system. Demand deposits are about 5 trillion, but the real number is other liquid deposits. It's almost 14 trillion. These are savings accounts, money market accounts. When the world wakes up that things are starting to get into short supply, what happens when that money supply, and a lot of it is held up in the banks, and what have the banks done? They've taken that money supply, they've purchased treasuries, and they've put it on the Fed's balance sheet, or it's locked up as a treasury. What if these institutions or people want that money to buy something because they realize the inflation's going up? You've got anywhere between 18 to 20 trillion dollars, just US, potentially coming into the market to buy something because people are starting to realize it's over. Growth is over. So now I better buy something before it's going to get hard to get a new car or to get a computer or to invest in a mine or whatever. So that to me is the most misunderstood part of the financial system. There's all this money supply. It's held up. Wait till it starts to come in. And that's where you're going to see the inflation happen. And so lastly, I see the countries moving more towards backing with commodities, even though the Jeff Snyders, the Lacey Hunts, the Stephen Von Meters think the bond market and this system of treasuries tends to work better because it's more liquid. There is way too many of those paper assets to back up the energy. And that's the problem. There's just way too many of them. They're going to lose their value. And so when we see the market wake up, they're going to try to exchange all that into something they can nail down on, which is precious metals and other goods and certain goods that they can say, okay, that's what happened during the hyperinflation. People kept buying things because the prices kept going up. We haven't really seen that yet, even though there's been some pretty good inflation. The world hasn't woken up that we're starting to go down to production and energy. That's when it really gets crazy, especially after 2025.
So, Steve, how do you think that some of these countries that are, let's say, commodity rich, are going to do? Take someone like Canada or Australia, for example, because you're saying that they're going to be starting to kind of back some of their currencies with commodities. How do those countries and later on the currencies of those types of countries do?
It's difficult. It's difficult to forecast how this plays out because, the idea we're going to go to central bank digital currencies. That can still happen. The problem with that is wait, we're going to have problems with the, you're hearing problems with electricity shortages in the grid, brownouts or blackouts coming this summer. What happens when that really gets problematic and you don't have electricity and you can't use your central bank digital currency? Even though we may have that for a little while, it's not going to be able to be sustainable. It's going to get into serious trouble. We're not going to be able to maintain a high-tech grid to have a central bank digital currency to work. And so it probably will evolve into the commodities, because I can tell you Russia looks like it's going to survive the most. Why? Because it only consumes about 40% of the oil it produces. So even if it loses 2 or 3 million barrels a day, it can still survive on its own with its domestic supply, even if it starts to decline in production. Australia may be somewhat in the same situation, and even Canada. The real problems are Europe and Asia. Europe imports, as I've said this, they import the most natural gas in the world as a region, and Asia imports the most oil. Europe is the second largest importer of oil, and Asia is the second largest importer of natural gas. So when energy production gets into trouble, those two are going to get into more trouble, especially Asia, because it is the goods producing market in the world. So, and then Europe, especially Germany, produces a lot of the high-tech goods, good quality engineering. And so, but in time, Tom, that the decline in energy production is going to go down the supply chain. It's going to impact the United States. It's going to impact Canada. It's going to impact South America. It'll take time, but it'll hit those as well, because the United States still imports 6 to 7 million barrels a day of oil, because our refineries are designed for medium crude, and shale is very light oil that our refineries can't use. So even if shale production declines, which it will, we still need to import a lot of oil to maintain the U.S. So these are many dynamics that, as they start to unfold, the volatility is going to be something else. And again, the precious metals won't provide you food, but they will provide you much better opportunities than most anything else as time goes on.
Steve, maybe explain to us a bit more about why we're going to see more volatility in energy prices as we approach the energy cliff.
The world has been increasing in energy production, and in the fat years, we've been adding inventories. And so it's like a bank account, right? You work hard, but you've got a savings account. So if you get laid off or whatever, the company shuts down, you can dip into your savings. And so you can go out and still buy groceries, pay your rent. That's what the inventories, oil and natural gas inventories are. Well, when that's a bank account for the energy system in the world, well, as I said, we'll know we're getting into trouble as the energy inventories continue to trend lower, and they will, because we won't be able to increase them. Of course, if the United States government says, all right, we're shutting down, we're rationing, then maybe, yes, we could increase the inventory if it comes down to that draconian, and I do see rationing coming. But that's when the volatility is going to hit, because as the inventories continue to decline, the buffer becomes less and less. And that's when you have massive volatility up and down. And because people need to realize, we're not going to just see high oil prices or higher oil prices, it's going to collapse too. It's going to be volatile. And that is very bad, because a system, whether it's an oil producer or whether it's a manufacturer, needs stable prices. When prices are volatile, it really disrupts the economy. And that's another factor, because I mentioned this before. We had the Cuban Missile Crisis in 1961. We had the Vietnam War in the 60s. Do you know what the price of a barrel of oil was from 1960 to 1970? It was $1.82. It didn't change. There was no volatility. Why? Because the Middle East was bringing on all this production that it had found in the 40s and 50s. And Texas was continuing to bring on production, as well as Oklahoma and California. That changed when the United States peaked in 1970. It all changed in 1970 when the U.S. peaked. That's when we had the major inflation of oil prices. And now it's going to be like on steroids as time goes on. And that's also going to be for natural gas too.
2001, go ahead, man.
Yeah, I think IEA, they have a projection probable reserves until 2052, if I'm not mistaken. But just adding to what you were saying about they're going to start rationing fossil fuels and et cetera. When it comes to Bitcoin, for example, you've seen they got kicked out, the miners from China, and if I'm not mistaken, Kazakhstan. So if we're going to start rationing energy, doesn't that mean that they're going to start prioritizing what this energy will be used for, especially in a fragile grid? Can you talk about risks that involve Bitcoin, like with the miners, with the chips, and energy as well, please? Thanks.
Sure. You see, Bitcoin, the semiconductor is the epitome of high tech. Well, Bitcoin takes it to another level. Now, it's a great idea. Cryptos, if we had Star Trek and we can just make things from Star Trek replicators, then it would be a wonderful thing, right? Unfortunately, we still live in a real world where there's resources. And unfortunately, a lot of the high tech guys, they have no idea about energy. Because if they did, they would slowly start selling their Bitcoin and they would slowly start moving out to the country. But they don't. And this is a problem with a lot of financial guys, economists, even many in the precious metal industry. For whatever reason, they just ignore energy. You could do that for 100 years, but you can't ignore it now. And so now the problem with Bitcoin is, I've said this, a Bitcoin miner has to be replaced every 2 or 3 years. That's the way it's constructed. That's the way it's built in. At 2 or 3, it could last a little bit longer. So you have to continue to replace those. And as the global supply chain breaks down, you're going to have less semiconductors. And then they're going to want to actually, maybe the governments are going to say, well, we need these semiconductors for this. Bitcoin is not going to get them. Because I can tell you, if governments want a central bank digital currency, I feel bad for Bitcoin because you may see more lockdowns on Bitcoin just for that reason. But moving forward, the high-tech religion is going to get into serious trouble because it just consumes a massive amount of energy. And so I do see, like Texas, they shut down, the Bitcoin industry said, well, hell, we helped Texas. We shut down the Bitcoin miners in February when there was a problem, right? Well, what happens when it just gets worse and worse? Even though there's governors trying to push for more, like in Texas, getting more Bitcoin, they don't realize what's happening with energy. And so I do see more countries, and then in the United States, I do see more states say we got to cut the Bitcoin miners because it's really not productive. We rather see it go into the industry or into manufacturing or for residential. And so that's the important thing. And you also need a Bitcoin miner to sell a Bitcoin or transaction in a Bitcoin. So it does you no good even if the grid is down and you've got your Bitcoin in a wallet. You can't really give it to somebody unless you can transition or transfer that through the system using a Bitcoin miner. So these are important factors that a lot of the high-tech Bitcoin crypto guys aren't really looking at because they continue to be ignorant about the energy cliff dynamics that we're facing.
Steve, you have a post on Twitter here, and you said that there's two dynamics taking place to do with the cost of production of gold and silver as well. So you said, one, the gold price based on the cost of production and supply and demand, And 2, the gold price will explode due to the energy cliff, negative impact on stocks, bonds, and real estate. So do you see, a real rotation of capital because of that negative impact on stocks, bonds, and real estate going into the precious metals? Is that what you're talking about when you say that we're going to see that interest come from institutions into the metals?
Logically, that would make sense, because if you look, Robert Kiyosaki and all these, how to build wealth. Well, you build wealth by getting into debt and really getting some other poor slob to pay your rent or to do the work for you. And that's what business as usual has been, because not every 7 billion people in the world can become wealthy, because you need some poor slob to do the work to give you the wealth. And I get that. I'm not against that, but that's the way the system is. So there's only so many wealthy people, because you can only extract that wealth if someone else is doing the labor or paying your rent or whatever. And so that's the issue we're at. And where have the wealthy put their funds? Stocks and in bonds, and now we've seen recently in real estate, right? Well, real estate, let's start with real estate. Real estate values, people still ask me this question, Steve. I get the stocks and bonds may collapse in value as energy production falls, but why would my house value fall? Well, we've seen this during the 1973 Saudi oil embargo. Basically, there was lines of cars to get oil or gasoline at the fuel station, and the traffic on highways just disappeared. Well, when you have less traffic going through a city or an economy, that means less economic activity, less people employed, less people to pay rent, less people to buy goods. And so the whole economy just contracts. Well, now you've got all these homes. People think there's a shortage of homes. There's not. Matter of fact, 10% of the real estate homes in the United States are vacant for various reasons. Well, wait till that gets to 15%, because you know what's going to happen? More people are going to get unemployed, and what are they going to do? They're going to move in with mom and dad. So right now, you've got people living in individual homes. When things get tough, they're going to move into one home. So that home's now vacant, and that's how it's going to happen. And that what is that going to do to real estate values? Real estate values are going to collapse. So that's, and not only commercial, but residential. And to me, the only place I see where real estate values will hold up or do well are in the country, a modest home on some acres. That will, because people are going to wake up and say, I got to get to the country, because this shit in the city is getting too difficult, because I can't rely upon the food in the supermarket, and the gas station's closed today. So that is coming. I'm not saying tomorrow, but that's coming. And then we've got stocks and bonds. And stocks are based upon earnings, right? Price to earnings. So if oil production falls, then economic growth falls, then earnings fall. Then why the hell would you own that stupid stock? Especially if it's not paying a dividend. And then lastly, it's the treasury or the bonds. And while we've got 1 month treasuries and 3 month bills, these are used as the liquidity that runs this entire economy, right? That's how you pay. You pay in these treasury bills. Well, then you've got the 10-year and the 20-year and the 30-year. And you don't really pay for goods and services with those. Those are more like a savings account. Well, you've got 20 trillion of those out there. That 10-year treasury or 20-year treasury or 30-year bond is only as good as you continue to increase economic activity, because that's how you pay the bond back, or the government does. So if you can't, those bonds get into trouble, again, not this year, we actually are probably going to see a bull market in the bond market when the stock market really collapses. But I think that's going to be the last bull market or short-term bull market in bonds. After that, especially by 2023, 24, 25, more institutions are going to wake up that the bonds are not protecting their wealth. It's the precious metals, because precious metals store energy value. They don't store energy. They store energy value. A bond is an energy IOU because a 30-year bond, it's 30 years to pay it back. And so that's the dynamic. That's where you're going to get the explosive price move in the metals when institutions and market wakes up that I got to protect my wealth in a real asset. It's not the increase of the cost of production that's going to be the big moves in the metals. It's going to be the wake up of institutions and investors to transition to protect their wealth. They cannot do it in those stocks, bonds, and real estate. And that hasn't happened yet because investors are still buying real estate. And it's amazing that they're still buying real estate.
Steve, when we think about, the metals doing well and going up, but yet we see, let's say, the value of some of these stocks going down, and recently the miners have gotten really hit alongside them. Do you see the miners being a good place to be, or just the physical metals?
Well, in the 70s, yes. In the 2000s, yes. Now we have to understand that you need a functioning global supply chain for a Barrick Gold or Newmont or Pan American Silver to continue to get the energy and supplies it needs to extract, produce that metal. And the equipment and the parts and the materials, they don't have years of stockpiles. They may have a months of stockpiles, but they need a constant supply of this stuff. So a factor that is not considered by many of the precious metal mining analysts is, sure, the price of gold could go to $2,500, but Barrick may not be able to get the materials and energy it needs to produce that gold, so that can negatively impact the company or mines, the different mines. And to tell you the truth, I don't know what that looks like. So that's, even though we could see people move into the miners with some of this money supply, like I've said, the 20 trillion of the money supply move into a miner, that could be that could push the price of the miners up, regardless if they can get enough materials to maintain production, even at a lower rate, let's say. So yes, we could see an explosive move in the miners, but it's not a guarantee. The guarantee is in the metals, the physical metal, but we still could see huge moves in the miners, but there are more variables now that are out of our control. It's more speculative than it's ever been.
Hey, Steve, I had a question on one of the reasons why I created a depository a number of years back and got into this business is the idea that you need to take delivery to secure from counterparty risk and systemic risk, because I think you're absolutely spot on. At some point, there's going to be a realization that you're going to have the real asset. Otherwise, you may run into settlement risks or other types of issues of converting that asset when you need it most. If we run into an energy situation, though, you could actually see a situation develop where delivery and settlement mechanisms start to break down because either you can't get the product to market, or people are taking delivery because of the exact reason that they're worried about somebody else not being able to settle that transaction. So it's now you just got to hoard it, I guess. Does that make sense to you?
Yes, that's the futures market, right? You see, everything is based on the futures market. And the futures market are supposed to work and protect not only the producer, the farmer, or the miner, but also the manufacturer or the company that takes the product and makes it into a product or food or whatever. It's supposed to help them, and that's what it was designed for. Gold and silver are different because they're also money and a store of value. Most commodities and energy and metals are not. Now, I see the futures market is going to get into serious trouble due to the problems with energy, and especially in the metals, gold and silver. I think we're going to see problems with the futures market. And so I do think the hoarding is going to happen. And I've said this many times, while the precious metal industry wants to place blame on the ETFs, I think the ETFs are going to be the place where the big moves are going to take place, because that's where institutions can move into, like the SLV, the PSLV, the GLD, the PHYS, the IAU, all these. That's where the institutions can park their money into metal. Now, does JP Morgan have all the metal there? I don't know. Is it oversubscribed? I don't know. But I can tell you, if a large institution is going to put $50 billion in there and they find out that JP Morgan has been fibbing about how much silver they have, they got a team of lawyers they're going to hang JP Morgan. And then if it comes out, well, JP Morgan only has half of the silver, what is that going to do to the silver price? So to me, the precious metal community should be applauding or, anticipating in a good way for the institutions to move into the ETFs, because that is going to be the eye opener, and that's coming. And so here's the number I give. The average allocation of the SLV is 0.2% for an institution. The large ones, like the big banks or BlackRock, it's 0.002. Can you imagine if the 0.2 just doubled to 0.5? And if it just gets to 1%, that's 5 times. You see, this is nothing. So I think the market, this is where I see the move in the metals, because the market is going to wake up to what's a real store of value, and the energy cliff is going to make that choice for them.
Also, when the banks start going long too, Bob, that'll help them as well. They tend to be a net short because of delivery, but banks also have a speculative, or they've got the ability to be speculatively long as a trade as well. When they start realizing that silver has $1 or $2 downside, but $20 upside, we get 10 or 20 to 1 risk reward. And I would love to see some of those banks start getting long, along with the institutions that Steve says.
Now, when you say long, are you talking about long on the future side, or because they may be long on the underlying, but they may just lift the hedge?
No, you're right. I understand. I'm talking about, that's what I mentioned. They tend to be short for delivery. A bullion bank does, but I don't want to speak for JP Morgan, but if we just use them as an example, they also have a trade desk. And when they start seeing that the risk reward is sharply in favor of being long, they can be long. And when you see them when they're long, they stop deliveries. It's a vehicle for them to receive physical.
Yeah. So one of the things that I was also kind of mentioning was, there's a lot of these digital gold programs and structured programs, and you see these balance sheet financing operations, that basically, like the Perth Mint unallocated or One Gold or some of these other programs that they basically take in funds and then use that metal to support their balance sheet operations or leasing method or leasing operations, that type of thing. One of the things I watch for is if he's right on, is that the cost of moving the material, the cost of leasing, the cost of financing, collateralization, all that goes up. And so it starts to squeeze the leverage out of the market. And that squeezing of leverage, I would think, starts to demand, okay, instead of the paper stuff and all the derivatives, I just want the underlying that's actually, I want the ice cream, not the toppings, I guess, if it makes sense.
No, Bob and Jim, I agree. And, there's been a lot of talk about the unallocated, whether it's the Perth Mint or wherever. And if you just look at numbers, because I don't even concern myself with those. Some people do, and that's fine. But it's like 10 or 15, 20 million ounces of silver that's supposedly unallocated. If we look at globally, it might be 20 or 25 or 30 million ounces. That's maybe a pool account, Kitco, and round numbers. Investors bought 2 billion ounces of physical gold bar and coin in the last 15 years. So it's a fraction. It's nothing. So real investors are smart. They've been acquiring physical. And to me, this is why I differ, because a small and medium investor should be buying physical metal. An institution can't really do that. They can, and I think some will, but they just move their funds around by a point and click in a stock or ETF. That's what they do. So if they want to move 5 billion or 10 billion here, that's what they do. And so the reason why the SLV is a better choice is because even though the Sprott is more allocated because it's held in the Royal Canadian Mint, I get that. It's a quarter of the size of the SLV. So if I'm a big institution, I don't want to move a lot into the Sprott because it's going to behave like a junior stock. I'm going to move into the SLV because it's got more liquidity. And so we have to realize there's two different markets. There's one for the institution and large investor. They're going to invest more in the ETF. Some may get into physical. And that's another thing. We could see even more get into physical. They may say, well, we just want to get the physical. So that's above and beyond getting into the ETF. So those are the two dynamics. The institutions moving into the silver ETFs and gold ETFs have been the main driver of price, not physical bullion. But I see physical bullion becoming more of a driver after the institutions move in. And so what the retail investors are suffering from high premiums, the institution or the wholesale market is going to suffer the same thing when the wholesale bars become short or tight. And that's coming. And when that comes, then it's just going to factor throughout the whole, you're going to see a huge increase in the silver price due to shortages in the wholesale market.
Yeah, and I totally agree with you because you're seeing, I mean, that's why I kind of tagged on this backwardation issue and the deleveraging is that once that starts to happen, it turns into sort of a confidence game, and gold and silver is somewhat of a unique asset because it's when people want it the most, it's when they can't have it. And that's where this they talk about, Morgan kind of quotes 90% of the move comes in the last 10% of the time with silver, but that's somewhat true because when it starts to move, it's like an avalanche starting, and then it just takes on a mind of its own.
Yeah, and Bob, I think one important factor we need to understand, I'm not looking to see silver get to 100, then I'm going to sell it. And then I'm going to get all these dollars. What the hell am I going to do with those dollars? The only reason you should sell your silver if prices really go up is because you need to buy something. That's the reason why you sell. You don't sell for profits, even though the price could go up and come back down to correct. You only sell if you need to buy something with that silver or gold, because what's the energy cliff dynamics are going to start funneling the 99.5% of investors out of stocks, bonds, and real estate into the metals. And so when that starts to happen, the prices are going to be volatile. They're going to come down, but they're going to come up because it's going to be like a 0.2% going to move in. Then 0.5% is going to move in. So you're going to continue to get tranches of more people waking up, more institutions waking up. And the reason why gold and silver store this energy value is because, like I said, 90 to 95% of the value of that coin or a bar is the energy in all forms and stages. A 10-year bond is based upon 10 years of economic activity in the future. So it's not a store of energy value. It's based upon burning energy in 10 years. and then 20-year bond and a 30-year bond. That's the difference that the market has been trained to believe, either institutions or wealthy investors or retail investors, well, I'm going to go into bonds because my pappy did, and that we've done it forever. No, you've just done it in the last 100 years. And that's the reason you've done that, is because energy production has gone up in those 100 years. Well, when it starts to go down permanently, that bond is no longer a store of value. It becomes an IOU. And you do not want to be in any IOUs, which are stocks, bonds, and real estate, during the energy cliff. So people still have time to transition. And as time goes on, Bob, I see more percentage of institutions and investors transitioning to protecting wealth.
What's interesting, though, is the way what I kind of see in these agreements, and I posted it today with GLD, starting to make it more difficult or giving them an out when someone asks for delivery or goes to an authorized participant and says, okay, I want to take delivery of gold. And so they put in some language. I kind of posted it earlier today. You're seeing more and more of that in these contracts. It's almost like they're kind of seeing what's coming. The banks with Basel III and getting out of these unallocated programs, and these reducing the leverage and exposure on their balance sheet. I think you're right on. I mean, that's the whole reason why I try to promote physical and get people out of these structured programs, because if we get into an energy situation, you're not going to be able to take delivery from your metal in Hong Kong or in Germany or somewhere else around the world, because it's just going to be too expensive just to even ship it. And so a lot of these foreign programs that people think I got to diversify could actually be, you're going to be forced to sell that metal in that country at that point because it's just too expensive to bring back.
No, you bring up a good point. So there's two dynamics. First of all, if I'm a big institution, why the hell would I want the silver? I don't need it. I'm not manufacturing anything. I'm not making coins. I'm not making solar panels. I just want to protect my wealth. And so the thing is, an institution, they want exposure to silver. I think they could give a rat's ass if they get delivery of it. Maybe a percentage would want delivery, but if I'm BlackRock, why the hell would I want a billion ounces of silver? Or why would I want 10 million ounces of silver? I want the exposure to the gain in silver. So the two different dynamics are, there's silver that's going to be used in the economy for investment, more investment in bars and coins, as well as it's silverware, jewelry, and also industrial demand. That's going to continue, even though that's going to decline. So we need to understand, if JP Morgan changed its prospectus after the Wall Street Silver February demand squeeze, that they may not be able to get the silver, well, let's take them for face value. They may not be able to get the silver. Again, if institutions move into the SLV, and JP Morgan has been fibbing about how much silver they have, that's only good for the silver price, right? Because we wake up and some guy in CNBC says, well, JP Morgan only has half the silver. Well, if I'm an institution and I just dropped a whole bunch of money and half of that's gone because the silver's not there, what is that going to do to the silver price? It's going to go up, so we should actually be very enthusiastic for institutions to move into silver, because it's going to put a spotlight on what's really going on. And let's say that JP Morgan does have all the silver. It's still going to be very explosive, because there's just not that much silver there. There really isn't that much silver for institutions to invest in. Even the silver that we don't know about, that's not reported, that could be 2 to 5 billion ounces. That's still nothing compared to the 400 trillion of stocks, bonds, and real estate value in the world.
Well, not only that, I mean, because I've talked on like the spaces before, is some of these, You've had Bank of America go from $800 million of derivative exposure to silver, platinum, palladium to now about $26 billion in derivative exposure over the last 2 years. And so I kind of looked into that. I said, okay, well, what the hell are they doing, and what is it they're actually investing in? And these guys are, they're creating like I like to kind of tell these things on spaces, but one of the things that JP Morgan has created was a product called an uncapped contingent buffered return enhanced note linked to the lesser performing of the Spider Gold Trust or the iShares Silver Trust. I mean, that's the kind of crap that institutions are buying, and it's just a debenture note or that has it's fully at risk. But that's the exposure that a lot of these institutions that you're talking about are wanting. They don't even care about the physical metal. They just want to have something on the balance sheet that says, okay, I'm in a commodity because I have to have an X percentage, like you're saying. But it's not defined exactly how that should be technically invested in, and that's where I'm trying to get institutions myself, because we deal a lot with high net worth individuals and institutions, and getting them more educated on the need for physical, because if we're all right and the dollar starts to drop at some point because of this energy cliff, it's the value of the metal that maybe, and it's distributable, that actually can be used as settlement. They don't have to pay it out in dollars at that point.
Well, I agree with you. We don't know to what level all these products out there, unallocated, allocated derivatives, we have no idea. We know what the skeletons are. So that's why it's always wise to be in physical. Number one. And of course, if you want to get into ETF, I highly recommend the Sprott gold and silver ETFs. Matter of fact, Central Trust, they are a Midwest company that is a financial company. They have investments. They are one of the larger investors. They are the third largest investor in the PSLV and the PHYS. And it's due to, and I actually contacted the gentleman in charge, the CEO in charge of investment. And he gave me this individual who started working at the company a few years ago, and it was his doing that got the older, management to start getting into gold and silver. And the best way he could do it was on the ETFs, and it's only like 3.5%. So you figure that this one company is 3.5% of their holdings is in gold and silver. Now, compare that to the 0.2% that's in the SLV. And it's even less on the Sprott PSLV. So I do agree with you. There's a big can of worms coming when people start moving, institutions start moving into the metals. It's going to open up a lot of problems. And so it's very important to be in the physical. But if I was going to be an institution, I would be in the major known ETFs, because these institutions can't go buy $1 billion worth of silver bars. That would wipe out the entire, right, Bob? If someone called you up and said, I need $1 billion worth of 10-ounce bars or 100-ounce bars, there's just not the supply. It's going to push it back.
Well, it's all relative, because you wouldn't buy $1 billion in 10-ounce bars, but you could go and buy 1,000-ounce bars and take delivery. And we've done some of these things where you're taking a large delivery either from the Comex or from Perth Mint or anywhere throughout the world. It can be done, and right now it can be done and held more efficiently than the ETFs. That's my big argument, is that Sprott isn't actually the most efficient method to actually own metal. The most efficient way to own metal is actually just simply buy the 1,000-ounce bars, take delivery, and pay a storage fee, because then you don't have the counterparty risk, you don't have potential nationalization risk or like Trudeau did, in Canada a couple months ago, where all of a sudden, the borders get closed, and how do you access this stuff? I mean, there's a lot of, this energy cliff scenario, which I think, again, I think you're right on, but it's going to create second and third tier type of effects that none of us were kind of expecting. And that's the whole reason to actually remove that counterparty and systemic risk from your portfolio. And I think institutions, if they start to understand that more, there's nothing to stop them from going to the Comex and taking 7.5 million ounces of metal standing for delivery and pulling it out of the system. But imagine what happens if that starts to happen. I mean, that's where you have complete unwind, and that'll create the panic in and of itself.
Can I be the broker for that deal?
Certainly. But it does go on. It's just that the ETFs, the only problem, I think you're absolutely right on. The ETFs offer a lot of liquidity, but the question is the liquidity going to be ultimately needed in dollars, or if the currency does start to drop, will the liquidity be better off actually in a physical item? Because that's a world that we haven't seen yet, is the need. If we go to a commodity-backed system, or even commodities become the currency, our world kind of changes here, because you don't have to have bonds anymore. Or you don't have the bond market as the savings vehicle.
That's a good point, Bob. And do you think that makes those programs that you can actually get physical delivery from, give them a more advantageous position to be in?
Yeah, I mean, but that's the idea, that if the ETFs are putting all this language in their prospectus and so forth, you start to have these issues that Steve's mentioning. Not only is it going to be more expensive to take delivery and put it on a boat and bring it over here if it's silver, or put it on a plane if it's gold, but you start to run into actual liabilities to your shareholders. I mean, if you're an institution and you have a responsibility, or fiduciary responsibility, and all of a sudden, you're buying a crap load of SLV, and now, you see the language going in there, and all of a sudden SLV says, well, we like last year, they put in that language that they may not be able to find the metal to put into the fund. Well, what's good is the fund at that point if you're an institution wanting to park 100 million tomorrow? I mean, but that's what people don't understand, is you can buy $1 billion or $500 million in silver through in a structured transaction where it's physical oriented, and you get delivery of that. Obviously it's not going to happen in 24 hours like the ETFs want you to believe, but there is depth to the market. There is structure to take that trade.
And gold would be easier. Gold's a much bigger market than silver.
Yeah. Yeah, and obviously you if you're an institution, if you're trying to park a few $1 billion, you're probably going to buy gold more so than silver, because it's greater store of value, or more condensed store of value. But I mean, the question is industry. Does industry start to hoard silver if it's needed for increasing for electronics or solar or some of the nuances, medical, whatever it may be. I mean, hell, today we have this, was it monkeypox virus or something now that we got to worry about? And so it's, you just never know what commodity may come out of the woodworks that helps attack or cure some of these things, but I think it helps to have some understanding of the legal ramifications of your investment and reading those user agreements, because if this whole thing does start to come unwound, what good is a dollar bill if the bond market starts to collapse and we run into this massive energy shortage and as well as the ability to pay back debt and so forth. I mean, eventually our system, which was designed to be the last man to fall, eventually that could happen. And that's where potentially this is why we're seeing some of this demand destruction in the stock market, because yeah, that's the only way to slow this freight train down on the supply side.
Bob, if we get silver to help fight monkeypox, that'll become the new chief enemy number one that'll be attacked.
Colloidal silver, Tom. Colloidal silver.
Hey, I'm aware of it, Jim, but yeah, there's just so many issues. There was a thing brought up today that there was a shooting or something, and it was mentioned that the person was a precious metals owner. And I saw some chatter on Twitter about that now they're going to demonize precious metals owners to lump them into this type of group of, extremists.
Well, you see, that's funny because the wealthy own a lot of precious gold and silver. I'm not saying all wealthy, but a lot of wealthy do. Then that's stupid, especially in Europe, the old money. So if that's the case, I can assure you there are wealthy people in the United States that own precious metals, and Bob can tell you as well. So it's not just, some conservative guy in Texas, with an AR-15 owning precious metals. It's a very diverse range of people.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.